Good morning. I'm Doug Murphy. I'm a tax manager here with DWD CPAs and Advisors. Today we're going to go over law changes that were made with the OBBBA and various planning opportunities for individuals and businesses. So what is the OBBBA? It's also known as the One Big Beautiful Bill Act or the 2025 Act. And recently we've heard people call it OBBBA or OBUBA. So there's plenty of names for this new legislation. What it is it's 870 pages of new federal laws, which includes the first major tax legislation that we've had since the Tax Cuts and Jobs Act was passed in 2017. So we're going to start today by talking about some individual tax updates. And we'll begin our discussion with the permanent extension of lower tax rates. For those who are wondering, for tax purposes, the word permanent essentially means that this is law until they change the law. So with the old Tax Cuts and Jobs Act, the rates were changed to range from about 10% to 37%, which were lower than the rates we had in the past, and the tables were a little bit lower. It created a higher standard deduction for everybody. So single people started at 15,000, had a household 22,500, and married filing jointly started at 30,000. Also, they eliminated all personal exemptions like your child exemptions in favor of child tax credits. So with the OBBBA, they decided that these rates were going to become permanent. And it says it's effective for the 2026 tax year, but as the TCJA was in effect from 2017 to 2025, there will be no interruption in the tax rates. So it'll just continue forward as if nothing really happened there. So the standard deduction rates will now be adjusted for inflation over time. With the TCJA, they were set to remain at the same level for those 7 years. And then permanent personal exemptions were permanently repealed. So don't expect any exemptions to exist for children or anything like that in the near future, but you will still have your child tax credits. One new exemption that was created as part of the bill is the senior exemption. So there were rumors throughout the campaigns that Social Security taxes would be fully non-taxable. This didn't turn out to be the case when we got the final bill. What we got instead was the senior exemption. So this exemption is available from 2025 through 2028, and you'll start to see a trend on these individual tax cuts that they're only available for the next 4 years. But this one allows seniors that are 65 years of age and older to claim a $6,000 personal exemption. Now, to be eligible for this, you must be 65 on December 31st of the tax year. And there is a limit. So if your income exceeds certain thresholds, the credit starts to become reduced. So these thresholds start at 75,000 for single taxpayers and 150,000 for married filing jointly. And this exemption is fully phased out for a single taxpayer making 175,000 or a married taxpayer making $350,000. Now I added an example here just to kind of show you how it works. So let's say that both of our taxpayers are over 65, so they each get a $6,000 exemption. The income would be limited a little bit. So they'd have excess income of $50,000. You multiply that by the phase out rate, and your phase out amount would be $3,000. So in this scenario, our taxpayers will be able to take $9,000 of senior exemption rather than the $12,000. This is all pre-itemized deductions, so you'll be able to take this even if you don't itemize. Another big campaign promise that was part of this bill was the no tax on tips provision. So this one also is temporary. It only lasts from 2025 to 2028 tax years. And it allows a deduction for up to $25,000 of your tips. So this limit is the same regardless of whether you're a single taxpayer, married filing jointly, or head of household. And then your adjusted gross income phase outs, they start at 150,000 for single taxpayers and 300,000 for married filing jointly. And then so your full phase out, if you're a single taxpayer, would be 400,000, and for married taxpayers, 550,000. This again is a deduction prior to itemized deductions, so you don't need to itemize to take this as well. More information regarding the tips. So the IRS has clearly defined who is eligible for the deductions. So if there are some crafty CPAs out there, unfortunately, they won't be able to just call any income tips. And if you're a business owner, you also must reduce your qualified business income for any tips that you exclude. So they kind of thought through these things before it just went a little crazy with crafty CPAs. No tax on overtime. This was another campaign promise that was made. So again, this is a temporary deduction for 2025 through 2028 tax years. It's pre-itemizing, so those that don't itemize can take the deduction. This one differs slightly from the no tax on tips provision. It's a deduction of up to $12,500 per spouse. So, for example, if you have one spouse who has 6,000 in tips and another overtime, sorry, and another taxpayer that has 40,000 in overtime money, they would only be able to take the 12,500 for the spouse with 40,000 and the 6,000 for the spouse with 6,000 in overtime pay. Now, qualified overtime pay is also clearly defined. So this is your amount in excess of your regular pay rate. So if you're paid time and a half in overtime, you would only get to take that portion for the half for your deduction. This is clearly defined by the Fair Labor Standards Act, and it must be reported to the IRS starting in 2026. So in 2025, if you have overtime on your W-2, it may not be reported to you and is not required to be reported to you. So it's important that you give all of your tax information to your tax advisors this year. And this is subject to the same phase out range as the tips deduction. So it fully phases out at 275,000 for single people and 425,000 for married filing joint. Another new provision for taxpayers is the auto loan interest deduction. This is available for 4 years, 2025 to 2028, and you'll be able to take up to $10,000 of interest paid on the purchase of a vehicle as a deduction prior to itemizing. There are quite a bit of stipulations on this, though. It must have a gross vehicle weight rating of less than 14,000 pounds, which is most of your standard automobiles. It must be the initial loan on a new vehicle, and final assembly of that vehicle must have been done in the US. If you're eligible for this interest deduction, you will receive a statement from your lender. And the phase out range is actually much lower than the other new tax provisions for individuals. So it fully phases out for folks at about 150,000 for single taxpayers and 250,000 for married filing jointly. Another provision that was a heated debate during the Tax Cuts and Jobs Act, when that was passed, is the state and local tax deduction cap. So, as part of the TCJA, they put a cap on your state and local taxes that you could itemize of $10,000. This really limited some folks, especially those in high real estate tax states like Illinois and Florida, because they could only take $10,000 on their tax returns when they could take much more before. So this is for state income taxes, sales tax in some cases, real estate taxes, and personal property taxes. your combined limit is that $10,000 per the Tax Cuts and Jobs Act. Now, with the OBBBA, this cap was increased to $40,000. This one has different years that it's eligible for, 2026 through 2029, but it does revert back to the $10,000 threshold in 2030. And then your caps are increased by 1% annually for inflationary purposes. However, this does also come with some limitations as your credit, or not credit, your deduction can be reduced by your income over $500,000 or $250,000 for married filing separately. So at the end of the day, if you make $600,000 or more, you will be limited to the $10,000 deduction. So it cannot decrease below that $10,000 deduction. So just keep that in mind for high income taxpayers. You may still be limited, unfortunately, to that $10,000. Charitable contributions. So as of the new bill, the 60% of AGI limitation was made permanent. So you can now still deduct up to 60% of your income as charitable contributions. And starting in 2026, there is a new deduction for non-itemizers. So this is up to $2,000 for a married filing joint couple. And this would be before itemizing. However, the one stipulation is this is only for cash donations. So any donations to Goodwill or any other non-cash donations would not count toward this deduction. We've had a deduction similar to this in the past. I believe it might have been COVID times or a little bit before where we got $300 to $600. But this is a good deduction for those folks that aren't itemizing that still want to get some benefit from their charitable contributions. And there's also a new charitable contribution floor that's being created as part of the bill. So this also starts in 2026, and it's 1/2 of 1% of your modified adjusted gross income. So as a result, any amount below that 1/2% floor will be non-deductible as a charitable contribution. Let's say you have $400,000 in modified AGI. All of your contributions at or below the $2,000 mark would be disallowed. So that's about a $600 impact on your taxes for the year. As we went through these calculations, we were happy to see that it wasn't as taxpayer unfriendly as we thought it would be, but it's still unfortunate that there's a cap on charitable contributions that disallows some for people that are itemizing. So one way that people can get around this, some strategies to consider. You can do bunching, where you do multiple years of charitable contributions in 1 year. That way you only get hit with the AGI limit one time. Or if your AGI is going to be lower 1 year than the next, you could plan around that. Donor advised funds are a good option for people and something we're seeing a lot more nowadays, where you can donate the money now, but send it out as you see fit. And then for folks that are over the age threshold, you can also do qualified charitable distributions. That won't be affected by anything. You can just make those as normal and you won't be subject to this 1/2% floor. Now, this is the fun one that people really like to see. It's not really fun if you're a gambler, though. So there is a gambling penalty now. So this is one that I could see changing because it seems like there's a big lobbying effect for this. So we'll see if this sticks around. But for now, this is the law. So if you're a recreational gambler, your loss is limited to 90% of your winnings. So, for example, you win a $100,000 jackpot, but over the year you spent over $110,000 to get that $100,000. Now, on your tax return, you're claiming $100,000 of income, but you can only deduct $90,000 of your losses on Schedule A. So this creates phantom income of $10,000 when you actually had a loss of $10,000. So it's kind of a 20 grand swing there that is unfortunate for the taxpayer. And this also um, limits professional gamblers to just their losses that they have. So if you're a professional gambler filing on Schedule C, you will no longer be able to claim losses in excess of your income. You'll just be able to deduct those losses to the extent of your income. We have some business tax updates as well as part of the new bill. So bonus depreciation. As part of the Tax Cuts and Jobs Act, bonus depreciation was starting to be phased out over time. So in 2025, we were limited to 40% of our purchases as bonus depreciation, and the rest had to be depreciated over time. So now with the OBBBA, they've made this permanent 100% deduction for your purchases of certain assets. So it's really a great tool for taxpayers because they'll be able to purchase some equipment and be able to take the full expense when the cash goes out. So that's a very taxpayer friendly provision in the law. And now your accountants no longer have to guess and wait for retroactive changes every year as Congress made this permanent. But the one caveat for this is in 2025, this is only for purchases made on or after January 20th of 2025. There may have been political reasons for that, but we're not going to get into that on this conversation. Also, Section 179 expensing was expanded. It could be limited as its usefulness, as a lot of people will prefer bonus depreciation over the 179, but it's good to know still. So we have a $2,500 or $2.5 million expense limit now and a $4 million purchase cap. And this also starts with 2025 tax returns. I don't believe it has the January 20th start date, and this will be adjusted annually for inflation. So for those folks that prefer to do 179 expensing, that option is available as well. Probably one of the largest and most important provisions that needed passed as part of the OBBBA was the extension of QBI. So qualified business income deduction was expected to expire at the end of 2025. This is a 20% deduction for those who have flow-through entities, which essentially tries to match up the tax rates between people who own businesses through flow-through entities and corporations. So fortunately, the OBBBA made this deduction permanent. So there doesn't have to be a lot of work at the end of this year changing people's entity types to corporations. And then some phase-out ranges were also increased per the new bill. So this is both for high-income taxpayers and those with specified service trade or businesses. And then there is a new minimum deduction of $400 that starts in 2026. Another big provision that has helped our clients is research and development expenses. With the Tax Cuts and Jobs Act, these were required to be capitalized over 5 years for domestic purchases or 15 years for foreign purchases. Now, as part of the new bill, they're allowed to expense these again. So as the cash flows out, we're able to take the expenses. So it's a very taxpayer friendly provision. And this, your foreign research and development costs are still required to be capitalized over 15 years, but the OBBBA now includes software development as part of your research and development expense. So for the people that had capitalized some R&D costs in the past few years, there are 4 options now for taxpayers on how they want to treat these old amortized costs since they're now expensable. So taxpayers can continue to amortize their capitalized costs. Say their income's going to be a little lower over the next few years and they don't want that deduction right away. They can just continue to amortize it over the next few years. There are also two other elections that you can do. You can elect to deduct your unamortized balance in the next tax year. So in 2026, you can take the full amount, or if you want, you can spread that over 2 years and deduct it over the next 2 years. And then there's another option for qualified small businesses, which would be any small business that averages less than $30 million over the last 3 years. They have all the options above, but they have an additional option to go back and amend their 2022 through 2024 tax returns. But this must be done by July 4th, 2026, or you got to pick one of the three options above. Your energy tax credits. As of right now, my advice would be if it has anything to do with an energy tax credit, a clean vehicle credit, clean air credit, just assume it's gone. The new bill cuts almost every single one of these credits. The effective dates are all over the place, so each credit's got a different effective date, but the latest one that I could find was the 179D credit, which is set to expire on June 30th of 2026. And then I have a few other miscellaneous business provisions for you. So there's further restrictions on employer-provided meals. So if you're providing meals to your employees, you may want to talk with your tax accountant to see if those are still deductible. There's new ones that are no longer deductible. Excess business losses, this was permanently extended and your limits were revised. So keep that in mind if you have large losses on a corporation or your business this year. There was an increased floor for your business interest exclusion. So you'll be able to take more business interest because the calculation was using earnings before interest and taxes, but now it's earnings before interest, taxes, depreciation, and amortization. So you'll be able to use more interest deduction for those that were limited. If you're a FICA tip credit, if you're someone who's eligible for that, this now applies to beauty services. So for salons, if their employees are paid in tips and they receive tips that they pay Social Security on, you may be able to take the FICA tip credit. For those paying vendors for services over $600, starting in 2026, this threshold is now going to be $2,000. So if you need to file 1099 NECs or MISC, that threshold is now $2,000 for 2026 and going forward. And then for those folks who sell on Etsy or eBay, the 1099K reporting threshold is reverting back to our $20,000 limit or 200 plus transaction threshold. So unless you're above those numbers, you're not going to receive a 1099K. As it was supposed to be $600, but in 2025, they moved it back. And another provision I didn't write on here because it probably applies to a more limited selection of businesses. Opportunity zones have also been brought back. There's limitations on that, but they are back now. So if you have a purchase of a building in an opportunity zone, make sure to talk with your tax advisors about any credits that you can get. And thank you for watching our presentation today. Again, my name is Doug Murphy. I'm a tax manager here with DWD. And just if you have any questions, make sure you're reaching out to your DWD advisor and getting them answered. Have a wonderful day.